Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome back to Intelligent Investor Insights. I'm Bob Barone, joined as always by my son and co-conspirator, Josh. Boy, what a stretch heading into the end of 2025. Markets acting like they're standing still, but the narratives just keep changing, don't they?
Yeah, they sure do, Dad. And hey, thanks for not calling me your usual foil this episode. You know, the S&P and NASDAQ barely did anything for most of December. But if you just looked at the Dow and Russell, you'd think it was a pretty healthy year, right up almost, 1% for the month?
Yeah, more or less. But let's not get too carried away with the scoreboard. The headline numbers for the indices are never the full story. Russell and DJIA are, I think, barely edging out their 2024 numbers, while S&P and NASDAQ, big tech, won't repeat last year's surge. I see people start high-fiving each other over stray calendar results. Reminds me of the end of 18. We had a wild rally into December. Everyone cheered, then, bam, reality sets in.
Classic seasonality gamblers, right? Where everybody suddenly believes the last 3 weeks represent the next 3 years. I try to tell clients the same thing. Don't chase the tape, chase cash flow. But here we are. Market modesty feels less like a pause and more like nobody really buying the narrative or selling it either.
Exactly. And this year, it really felt like the market was more interested in parsing every wobble of the Fed than anything else. The 25 basis point cut, yeah, that was priced in. But what actually surprised people, or maybe just the ones not paying attention, was the split at the Fed. 3 dissenters out of 12. Josh, when was the last time you remember that many FOMC members at odds with the chair?
Honestly, I don't. I mean, 2 dissents, sure, but 3? And then counting all the alternates, it's almost 40% of the Fed saying, nope, we disagree. That's wild. Not sure if that's a healthy debate or just a sign of serious internal confusion.
It's both. If they're this divided on a cut everybody saw coming, what's going to happen when something unpredictable actually hits? Anyway, just a reminder, don't read too much into surface level index returns, especially when the Fed's having an identity crisis.
All right, so let's talk jobs, because frankly, November's data had me rubbing my eyes like it was 2008 all over again. Payrolls down 105,000 in October, barely eking out a positive for November. And that's before you even account for those mysterious BLS birth-death add-ons. Basically, we're looking at negative real job growth for 2 straight months, right?
That's right. October's payrolls are down. And when you back out the plus 90K from the birth-death model, don't get me started on that, those numbers turn really ugly. The U3 unemployment rates jumped to 4.6%, the highest since September of 21. U6, the broader one, nearly hits 9%. Full-time jobs down nearly 1 million. And you're seeing a massive spike, nearly 1 million more people forced into part-time work. It's a sharp deterioration, not some gradual shift that's easy to digest.
Yeah, and that's what makes me nervous. I had a client back in 2008. Big plans, stable gig, then job's gone with 0 warning. Took him from I'm set to scrambling overnight. Seeing stuff like this again, rising self-employment, people patching together multiple jobs, it's not just data, that's household stress, the kind of stuff you can't fix with a rate cut and a pep talk.
Well, and let's just call it out. The Fed's own forecast for unemployment next year is already out of whack before we even start the calendar. I don't want to belabor this, but when the supposedly robust labor market is built on forced retirements and part-timers, It's not a sign of underlying strength. It's smoke and mirrors. And the pace of this deterioration, that's what should worry investors right now.
Yeah, it's not just a blip, it's a turn on a dime environment. And all those forced to take more than one job or hang a shingle as self employed, that's not economic vitality. It's adaptation under duress. And that never signals a bottom.
So let's dig into the Fed's actual moves. Everybody's focused on the 25 basis point cut, but the more interesting part, the part that got buried, was that they've dumped quantitative tightening altogether and are now buying $40 billion a month in treasuries. That's QE, folks. Not just a tweak, but a major regime change.
I'm glad you highlighted that because, like, you turn on Bloomberg and it's all rates, 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 but nobody wants to talk about asset purchases restarting. And again, that FOMC split, 3 dissenters out of 12 voters, 7 out of 19 total. Dad, you ever seen that kind of visible internal disagreement before?
Not in modern history. It's usually window dressing. Even when there's a split, it's just 1 or 2 token votes. This is a bona fide fracture about what the economy needs. You've got 2 folks who didn't want to cut at all and 1 pushing for double. That's not a debate about timing. It's about fundamentals.
And it makes you wonder, right? What data are they actually looking at? I mean, half the committee seems hung up on lagging inflation prints, and the other half's looking at a labor market chart that's just falling off a cliff.
That's the real mistake in my book. Relying on lagged data, especially inflation, has led the Fed into almost every major policy error in the last 2 decades. I've said this before. If you're waiting for backward-looking stats to confirm a turn, you're going to be behind the ball every single time.
It's like steering a car by looking in the rearview mirror. A terrible analogy, but you get my point. All I know is, with their new stance, we should expect easier for longer. Bonds and stocks are pricing that in, even if Main Street still hasn't felt the benefits. All right, let's get into the circus surrounding the Fed chair. Powell's term as chair is up in May, but he's saying he'll stick around as a regular FOMC member until 28, which, by the way, is totally not the norm. So, Dad, what's your read here? Are we in for more political theater, or does this really matter for markets?
It absolutely matters. And yeah, it's political theater and also structural risk. Traditionally, the outgoing chair steps aside so the new chair can slot in. But Powell's digging in, which limits Trump's options for who he can appoint. Now, you've got rumors about Kevin Hassett, Kevin Warsh, maybe even Christopher Waller as outsider picks. And then this curveball with Lisa Cook's Supreme Court case, it's just another layer of uncertainty.
I mean, at this point, is the market more concerned about who gets the chair or what unpredictable policies could show up because of that leadership shuffle? It seems like chair roulette could make 2026 even choppier than the Fed's actual policy stances.
The real risk isn't just who the chair will be, but whether the transition paralyzes the committee. If the Supreme Court ruling hangs out there and Powell won't leave until 2028, you could end up with a lame duck chair or a power struggle at the precise moment when policy clarity is critical. That's not good for investor confidence in any asset class.
So basically, watch this like a hawk, but don't try to bet on DC drama fixing your portfolio. Uncertainty is the only thing we're guaranteed in this cycle, right?
Let's wrap up with a positive for once. Inflation, headline CPI, up only 2.7% year over year in November. Core at 2.6%. Markets cheered, but really, this is what we expected months ago. The lagged rent data is finally rolling off, something we talked about last spring. It took its sweet time, but now it's clear in the numbers.
Yeah, and you know I keep one eye glued to energy since any blip makes the tape twitch. But even with all that volatility, the core trend's marching down. For the first time in years, you could argue inflation is more of a rounding error than a headline risk. I might celebrate with a $7 gallon of milk and a sarcastic toast.
Just as long as you don't buy it on credit. Seriously, though, the takeaway is that the Fed's hand is now even freer to ease. The easy side of monetary policy looks set, at least for the coming year. Rate cuts and asset purchases are both on the table. And finally, the inflation component that kept them frozen is moving the right direction.
So for investors, don't get spun by every doomsday headline. Watch the core data, not the noise. The playbook hasn't changed. Discipline, patience, and don't chase what you don't understand. Well, I learned that one from you, Dad, after a few expensive mistakes.
Glad to know some of those scars turned into wisdom. Okay, that's our read on Fed shifts, labor markets, and leadership roulette for the end of 2025. Josh, always a pleasure. Try not to become an inflation hawk in my absence.
No promises. Thanks for tuning in, folks. Plenty more to dig into next time. See you soon, Dad.
Take care, Josh. Thanks, everyone, for listening. Until next episode, goodbye.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.